I'm Morella Fernandez. Welcome to Market Call. Jerome Hass is on the show today. He's portfolio manager at Lightwater Partners, and he'll be taking your questions on Canadian mid-caps. Here's how to reach us. 1-855-326-6266. And you can send us an email to marketcall@bnnbloomberg.ca. Jerome, thanks for coming in.
Thanks for having me.
We know Donald Trump is creating, well, essentially chaos almost everywhere. He's got a lot of tariff threats out there. But you believe that he's going to actually follow through. A lot of people think it's just bluster. Why do you think he's going to follow through?
Well, I think partly he wants to establish a reputation that he's going to be able to amortize, if you will, over the next 4 years of his administration. And so it makes sense to put as much irrationality up front and to invest in that. And, you look at the situation with Chinese tariffs, where he imposed a couple of weeks ago a 10% tariff. Up to the inauguration, he was talking about a 60% tariff. So if you talk about a 60% tariff and you go ahead with a 10%, the market's happy about that. The Chinese basically rolled over and said, I can live with that. Chinese stock market is up 14% month to date. So clearly the market's happy about it. That's a lot less than he thought. But I think he's going to continue to act perceived to be irrationally and chaotically in order to maximize his impact. Okay, so what do you do as a result of that? What's your firm doing? Well, we really batten down the hatches. I mean, if you'd asked me in New Year's what the chances of tariffs are, I would have said less than 5%. And then in the second week of January, we went to a couple conferences, and two oil and gas ones in particular. And we asked every oil and gas person that we met, do you think you'll put tariffs on? And to a person, they all said yes, which really surprised us. So we definitely pulled back on our oil and gas exposure. We literally sold it at that point as a temporary measure, and we raised cash. So we're at the highest cash levels we've been in a very long time. Even though energy tariffs are expected to come in at 10%, or at least that's the threat at this point. Yeah, it's perceived to be that they'll be lower, and I think even Trump's realizing that putting even a 10% tariff is going to cause a lot of disruptions in it. But it still will impact certain stocks in the sector, particularly those in downstream operations. Are you surprised that the market itself is not reflecting instability at this point, or the amount of instability that seems to be in the air? Yeah. At one point, the market was up like 5% in January, and we were like, what is the market thinking here? And the only conclusion that we can come to is they don't believe that Trump's going to go through with this threat. And they thought maybe he would be a business-savvy man who would make some great moves on behalf of business. Have you seen that? Well, he certainly made some moves towards deregulation. I mean, the reason why the market has rallied since the election victory in November is because they perceive he's going to lower taxes and he's going to reduce regulation in the states, which should be a benefit to markets. But what markets don't like is uncertainty, and they don't like arbitrary decision-making. And that's what we've got since January 20th. And so we're very surprised the market hasn't reacted more adversely to that. Okay. We are going to take a quick break, be back with Jerome Hass. He's portfolio manager at Lightwater Partners, and we'll be taking your questions today on Canadian mid-caps. There is a number to call us at, and market call at BNNBloomberg.ca if you want to send an email question. Back in a moment. Welcome back to Market Call. We have Jerome Hass here in-house to take your questions on mid-caps today. But we do want to start with an email. This one coming from BC, from New Westminster. It is about CAE. Can I have your guest forecast for CAE, which is, I guess, an aviation training company? That's right, yeah. So they have simulators, and they're the world leader in this, that most pilots who are not training in the air train on their facilities. Okay, and? So we like the name. It's actually had a reasonable run of late, as you can see from the chart over there. It did have a little bit of a hiccup in the short term in the civil business. And so they essentially have two components. One is civil that the airline pilots trade on, the other is more military and defense. And in the latest quarter, there was a bit of a slowdown in terms of the civil side, which is we think, a short-term phenomena. In the longer term, approximately a quarter to a third of the airline pilots are going to be retiring as mandatory retirement age. So there's a natural evolution where they have to be trained. And so it's not just the top pilots that need to be, so the guys that go from B to A, it's also the guys who are at C go to B, and the guys who are at D.
So it's a constant flow, essentially.
So, yeah, the whole spectrum needs to be upgraded when they have these retirements, which is good for CAE and their business. And so organically, we think they probably grow high single digits, say 7 and 9% organic growth, which is pretty good growth. The downside is that they've had a pretty good run of late, and so valuations are a little bit expensive in this. So I would say it's a hold right now. If you own it, it's a good one to continue to. There's nothing wrong with getting high single-digit growth.
Do you want to wait to get into it then?
I probably wouldn't be buying it at these levels, yeah.
Okay. All right, let's go to the phones. We have Sal on the line calling us today from Toronto. Hi, Sal. What's your question?
Hi, thanks so much. My question's on GoEasy. Recently, the earnings report seemed good to me, but it's kept on a downward track down. And so given your guest's view that Trump seems to be serious about his tariff threat, the reason for the stock dropping, is this just jitters from the impacts of what could happen, or is this actually a good time to buy? Looking forward to hearing. Thank you.
Yeah, so the problems with GoEasy, it's a position that we own, it's one of our larger holdings, really started on July 4th when the CEO unexpectedly announced that he was resigning. And so if you look at, that's kind of when the stock peaked. It was pretty close to 200 at that point, and it's pulled back since then. They've done reasonably well in terms of the Q3 earnings and Q2 earnings. I think they're about, I can't remember if they have released the Q4 ones yet, but it's really the uncertainty about the CEO. So David Ingram, who was the previous CEO, has come back from the board, so he's acting as the interim chair or CEO right now. We think he's a safe set of hands. Jason Mullen did a great job for 6 years running GoEasy. He's going to sit in the board, so we think it'll be a smooth transition. They're looking for a new CEO. And now I think about it, they did come out with results, I think it was this week or last week, and the issue with the Q3 results was whether the delinquencies, and so they seem to have stabilized, which made the market reassured. So the stock did rally a little bit on the news, if I recall.
Okay.
So it's a name we like, it's cheap, it grows at 15-20% in the long run, and compared to where the banks are at, I'd rather own GoEasy at 10 times earnings than one of the banks.
Okay, sounds good. We'll move on. Sorry, I just mentioned it was 169 trading today, and you mentioned it was down from 200 about 6 or 7 months ago. Let's go to Jason. Jason's on the line calling from North Bay, Ontario. Hi, Jason. What's your question today?
Hi, Jerome. A long time ago when you were on Market Call, you used to be short Cineplex, and I understand now you've gone long since the pandemic. I also did the same thing. Just wondering if you could give us a little commentary on that, and what portion of your portfolio would you say is long versus short?
Yeah. Well, I think it does give us some credibility in the name because we were short for a very long time. We thought when the stock was trading north of $50 that it was overvalued, and it was trading at like 15 or 16 times EV to EBITDA. And we actually had a debate on BNN against another portfolio manager. I was the bear case, and he was the bull case, and why it was worth more than $50. So fast forward to COVID, stock's trading at $7. We thought, okay, well, there's a lot of negativity priced into the stock, so we did a little bit more homework. We liked it. The stock had traded off hard because the deal to take it private at $34 had collapsed. And so it's kind of been an orphan stock since then. And Canada is very much a momentum market. No one really wanted to own it when it was at $7 and during COVID. But we recall the days in 2008 and 9 when this is arguably the most over-owned stock in Canada. Everybody loved it because they viewed it as recession-proof. So even in the Great Recession, people still went to movies. Now, the argument since then is that with the advent of streaming services, that a lot less people are going to movies. Well, it's actually reasonably flat in terms of attendance. And so we view this as stock that should be able to grow at low single digits. But for a consumer stock, we're okay with that. And we think that the market's really not recognizing the underlying value in Cineplex. Because you think about it, they have 75% market share in a G7 country. That's almost unheard of in a consumer product. And yet the market's not really embracing it. So
it's really hard with Cineplex because they are trying different things to try and bring people back to the theater, like live sports events. I know they've tried that out as well, but it's a hard one.
Well, at the end of the day, people still go to the cinema, and the cinema experience. Like you think about during COVID when everyone was streaming. I don't remember a single movie I saw then, but when you do go to the cinema, it's something that you do remember. I remember all the films that I saw last year. Those will come up in Oscar time, but
it's more of an event when you're watching.
It's more of an event, but it's also a relatively inexpensive night out. It costs a lot less than going out to dinner or something like that. So it's kind of an inferior good in that sense. But we just think that it's a good story.
Okay, we are going to take a quick break here on Market Call. Back with more of your questions for Jerome in a moment. Welcome back to Market Calls. Jerome Hass in-house to answer your questions today, and we have a caller on the line. Rob is calling us today from Alberta in Calgary. Hi, Rob.
Hi. Thanks for taking my call. I'd be interested in hearing Jerome's opinion on the TC Energy spin-out South Bow Corp, or if he has a preference to the other Canadian pipes such as Pembina or Enbridge. And given his opening remarks on the energy stocks and the Trump tariffs, are the pipelines a safe place to hide? I'm looking for total return results on both growth and dividend payouts. Thanks again, and have a good weekend.
A really good question right there. People are looking where to keep their money safe at this time. So for mid-caps, what's good?
Well, to be honest, there's not a lot of pipelines that are in the mid-cap space. So this is a little bit out of our sphere. But my mom actually got some South Bow, so I started paying a little bit more attention to it. It was, as Rob identified, it was a spin out of TransCanada. And so, what was initially attractive about it was the high dividend yield on it. It was about 8.5%, 9%. And so I think people like that a lot. It's a relatively conservative, low growth story in terms of South Bow. And so if you just like the dividend, happy to sit at 9%, which is something to be said for that. Initially when it came out, I think it was around the 30s, $30 level. I thought when it got up to 36, you'd probably start to see people trading it. It's kind of hung in there. And whether or not the perception amongst the sell-side analysts is that the pipelines are safe, but it's a world of uncertainty. So of the names that are out there, I think it's relatively safe names to play, but I don't have 100% certainty with that, and I'm not sure anybody does at this point.
Okay, let's go to our next caller. David is calling from Ottawa today. Hi, David, what's your question?
Yes, good afternoon. Thank you for taking my call. I guess the previous caller stole my thunder. My question is on Pembina. And I noticed that a lot of the pipeline stocks from large cap to mid cap, I guess, the prices have been going downwards. Is there a reason that the entire pipeline industry seems to be taking a hit? I guess you may have answered the question as to whether or not you own Pembina for yourself and for your clients. Thank you very much, and have a great day. Take care.
Yeah, David, we don't actually own any in our funds because it's too large for what we're looking at. But again, my mom has a position in it, so I do.
Your mom likes to go big.
She does, yeah. So we do pay attention to it. I think Pembina is the third largest pipeline stock in Canada. To be honest, we like all of them at this point, and I think one of the things that we're recognizing is we need more pipelines in this country, and those that have them are worth something. And I think that's the key takeaway from all this uncertainty that we're having. And there is a recognition politically that we need to build more pipelines. We should have built Energy East 10 years ago. We should have built a whole bunch of other pipelines. And so those that do have pipelines are going to be pretty gun shy about building another one. You know, I know TC Energy is not enthusiastic about restarting Energy East, but we need somebody to build these pipelines. And so the pipeline companies may not be too eager right now, but they're the logical people, if we do build them, to own them.
And they fall in and out of favor, right, all the time, and there's a lot of hype around it.
Yeah, but I also think it's a pretty good place to hide. I mean, interest rates will come down, we believe, later this year, and so the yield that you get off those is attractive. I think there's worse things to hold than a pipeline, and so we're pretty enthusiastic about them as a group.
Okay, let's move on to our next caller. Then we have Brian on the line from Trenton, Ontario. Hi, Brian. What is your question today for Jerome?
A lot of people phone in about Manulife and Power Corp and Sun Life. I own a fair bit of Fairfax Financial, which I don't know a lot about. I was wondering about what his opinion is on Fairfax Financial. Does he own it? Does he think it's a hold buy, etc.? Thank you.
Brian, we actually do own the stock in both of our funds, even though it is larger than our normal cup of tea. The reason why we did was, I think it was last May or last spring, there was a short report on Fairfax. The stock dropped. We read the report, we thought it was gibberish, and so we stepped in and bought some. So we got a pretty quick 20% return on it. But then we look at it, it was still trading around book value at the time, and you look at their peers were trading at 1.7 times, so we just thought it's actually mispriced by the market. And we also like it as an alternative to the banks. We don't see the banks as having much growth this year, and so having a stock like Fairfax, I think, is which to us is just structurally undervalued, is a good holding to have. It's big, it's liquid, and so for institutions can actually participate in this as an alternative to the banks. And so I think it's a great stock. Prem Watts has done a good job. He's not foolproof. We've had a few of his positions where we've been on the opposite side and the short side of some of his long opinions, but overall he's been a very good manager in the long term. So I think it's a good place to park your money.
Yeah, I'm going to ask him to bring back the 5-year graph, because in 5 years it's gone up 250%. I don't know when our caller Brian actually bought in, but wow, that's a jump over 5 years. So it's worth a lot of money.
Yeah, but it's still very undervalued. Like, you can easily see 50% upside in this if it trades to where its peers are.
All right, we will move on then to Jim, who's calling in from Pickering, Ontario today. Hi, Jim.
Hi, good afternoon. Thank you for taking the call. My question today is on Whitecap Resources. I use this as an opportunity to trade Canadian, and that pays a good dividend if you do need to hold, and fairly liquid, steady volume. I'd like to get your opinion, please.
Yeah, Jim, we actually like the stock. We don't own it in the funds per se. I personally own it. And we were actually at an oil and gas conference in January, and one of the guys that we met was the CEO of Whitecap, who is a bit of a character in himself, but we just really liked him, his approach, and if you're going to back the jockey, he struck us as one of the guys that you want to be backing. So we like the name. I think it's a good place to park some money. We're temporarily out of the oil and gas space, but that's a very short-term trade on our part. We actually love the capital discipline that's come to the sector. We call it the Eric Nuttall effect, and we think that Whitecap is an example of that capital discipline.
All right, sounds good. Now, Jerome hasn't been on the show in a while, so no past picks today. We will take more of your calls in a moment when we come back. Stay tuned. Welcome back to Market Call. Thanks for joining us today. We're going right to the phones. Anita is on the line from Markham, Ontario, with a question for Jerome Hass. Anita, go ahead.
Good afternoon. Thank you for taking my call. My question is on A&W Food Services, now it's called. And could I please have your thoughts on this company, please? Do you think there's a lot of growth in this company, and whether the dividends are safe? And is this a good entry point, or should I wait for a dip? And also, could I have a street consensus on this company, please? Thank you. I hang up and listen to you.
Thanks, Anita. Go ahead.
Yeah, Anita, I'm going to say it's been a while since I've actually dug into the details of A&W as a company, but as a consumer,
they're great.
I was going to say I was recently added A&W, and I was kind of shocked how expensive it was.
I haven't been in a while. Are they pricey?
Yeah, I ordered a burger and I was like, I don't want the combo, and they're like, no, that's just the hamburger, and I was like, wow.
Got it.
So I don't read a lot of investment books. The one I read a long time ago, which kind of got me into it, was One Up on Wall Street by Peter Lynch, and basically he said, invest in what you know and what you like, and so he would experience a product and then go and investigate and see whether or not it was worth buying. It's kind of the opposite effect in this, in that I was shocked how expensive the burgers were. So it would not incline me to invest in the stock based on that, on Peter Lynch's methodology. So I'm just going to say, as a consumer, I'm not a big fan of A&W.
Got it. All right, let's go to an email then. We have an email from Jane today. Jane says, could we please have your guest's opinion on Element Fleet Management? So they are a Canadian company, and they basically handle fleets for companies around the world.
Yeah, so what they do is they have what's called telemetrics, and they have something which they put into fleets to help people manage them better. And it's actually come home. I remember, I haven't looked at the company in a while, but when we renewed my auto insurance this year, my company said, I'll give you a 15% discount if you install this app in your phone. And it's basically telemetrics, which is kind of the backbone of what Element does. And so they installed these, and they've had this for like 10 years or longer. And so it allows them to track vehicles and manage fleet on behalf of corporate clients a lot better. And so now, literally, every time I get in a vehicle, now my insurance company can see how the braking was, how the acceleration was, and that. So there's a lot more. They have a much more sophisticated telemetrics than that, but it just shows how that technology has now become a lot more mainstream in the market. So we do like Element. They had a spin-off of ECN, and I think it was 2016. So a lot of hedge funds kind of played that name and the spin-off around that time. They had a pretty decent run, I think, last year, if I'm not mistaken. I think they're trading at around 16 times PE right now, which is probably fully valued at that point. But they're still growing at about 11 to 12%, which is not a bad trend. So I don't think you're going to get a lot more upside to it from this point, but certainly having 11 to 12% growth for the next few years is pretty attractive. So
I'm surprised about your insurance company asking for you to put that on. It makes sense, but that's a lot of data then that it throws to the insurance company to have an assessment.
Yeah, well, it also, like, if you take the TDC, it includes that because it can't differentiate between a car and the TDC.
Really?
So they're going to ask you afterwards, say, were you on a public transit or not? So if you get it gives you a rating for your ride. So if you get a bad rating, you can blame it on the TDC.
Wow. Okay, that is a lot of information. Okay, I hope that was helpful as we move on to our next caller. Steve is calling from Toronto today. Hi, Steve.
Hi, how are you?
Good.
Hey, thank you for taking my call. My question is regarding Labrador Iron Ore Royalty Corp. I've been a long-time holder of this, and it pays a wonderful dividend, of course. But I was just wondering, in the face of even double tariffs, perhaps on steel and aluminum, I was just wondering what the outlook or the prospect would be for this going forward. I noticed in the last few weeks the price hasn't really come off in the threat of the tariffs and that, and I was just curious to know your opinion, please.
Yeah, so Steve, I'm not the best expert to perhaps comment on this. We sort of swore off resources at the end of 2012, so it's been about 13 years since we really looked at these in any depth. But when we did do resources, I love bulk commodities like iron ore, potash, or coking coal. Those are kind of the three that I used to focus on. And there's very limited opportunities to invest in iron ore in Canada, and Labrador Iron Ore is one of the few there. So Part of the dynamic that you're facing with them is global factors, is that steel demand and steel production has kind of peaked in China. And so there's a lot of excess capacity that's out there. And so it's actually a factor across the globe. And so I think that will potentially weigh on Canadian production, North American production. Tariffs clearly aren't going to help as well because there's going to be a lot of uncertainty in that. So I would be cautious on the name. But that being said, I think you've said that you've held it for a while. I think it's one that you hold on to. It's got a good yield. We like it long term. It's just a question of some of this uncertainty with Mr. Trump.
If you can survive the next 4 years, you should be okay.
Yeah.
Okay, we're going to be back with Jerome Hass. We're going to take a quick break. Hass is portfolio manager at Lightwater Partners, and we'll take your questions on Canadian mid-caps today. We're back in a moment. Welcome back to Market Call. We are going straight to your calls today for Jerome Hass, who's in-house taking your questions on mid-caps. Jack is on the line from Scarborough, Ontario. Hi, Jack. What's your question today?
Hi, my question's about AtkinsRéalis. I was interested in this space given that it's in engineering services, and I thought perhaps the Trump tariffs potentially looming, that it may not have as much of an impact. So I was wondering your thoughts on AtkinsRéalis and if you would be able to speak to the prospect of this compared to, say, WSP Global or Stantec and how it may fare. Thanks so much.
Got a young investor on the line there, too, hoping for some information.
Jack, I got to say, I'm not a big fan of the sector at all. I find them, they don't make enough money. They're difficult to really forecast properly. And yeah, it's not attractive risk return. And on top of that, as a Canadian, I wasn't very happy with SNC. So I know they've rebranded themselves under a different name, but still not a big fan of the sector, and I don't think it justifies the amount of effort it takes to know these names very well. I'm not sure they are that knowable. So it's a sector we generally avoid.
All right. I hope that helps for Jack as we go to an email question right now. This one is from Faye, who's in Saskatchewan. She says, I don't hold a position in Lightspeed. I'm interested to know your guest's thoughts, if this could be a time to buy, and general opinion on that.
Yeah, Faye, I would say it's not a time to buy Lightspeed. They had an announcement, I think it was last week. They'd put themselves up for sale in a strategic review, and they didn't find an appropriate buyer. So that's probably why you've seen the share price come off like that. The founder has come back as he had stepped down as the CEO I think he went back and got a BA degree. And now he's graduated, and now he's going to go put it to work at Lightspeed again. But essentially what the company said after, there's going to be some disappointment in investors when you don't sell the company, but they're essentially redoubling their previous efforts. And to us, it didn't work in past periods. I don't see why it's going to work this period. And so we wouldn't really be chasing the name. I think it's also one of these names where during the 2020 and 21, when all the tech names were booming, people made the mistake of getting caught up on the metric enterprise value to revenues. And so when you look at Lightspeed, it looks cheap in that metric. I think it's about 1.2 times. But it's not, we think it's a very poor measure to look at companies. So I would avoid it, Faye. If you don't have a position, stay away.
Okay. Let's go back to the phones, and we have Hampton on the line, who's calling from Toronto today. Hampton, what's your question?
Good afternoon. Thanks for taking my call. I'm a longtime holder of Air Canada. I've seen this stock go from $52 to $14. It's 17 days. I've seen airline recover from the COVID stock price, whether it's the American Airlines or the Lufthansa, any airline in the world but Air Canada. I'd like your opinion on what I would do. Should I hold this stock or just wait for it to recover somehow?
It doesn't seem to find its place, I think, is what Hampton is saying, and it really doesn't seem to. So what's your take on Air Canada? They reported earnings last week.
Yeah, we're not big fans of Air Canada. Warren Buffett, up until about 5 years ago, famously said that the Wilbur brothers were like worst thing ever to happen to investors. We tend to agree with that. So we think it's a trading stock at best. We're not traders per se, so we tend to avoid it. We have used Air Canada in the past for hedging purposes. So we used to be short WestJet when WestJet was listed, and so we'd use Air Canada to hedge some of that position. So I have held it in the past, but sort of with my nose plugged. It's not a name I particularly like the fundamentals or don't like the fact that it's an oligopoly as a consumer either. So I'll leave it to someone else to trade. It's really not our cup of tea.
Got it. Okay, let's move on to another caller then. William is on the line from London, Ontario. Hi, William.
Good afternoon. I own CNR, and I was thinking of trading it in for Descartes. Do you have an opinion, please?
Yeah, we love Descartes. It's a name we actually bought in 2011, around $6.50. And then I remember we had a debate with a sell-side analyst at the time, and the argument that we made was they make a lot of acquisitions, and so essentially what they are is they're a play on trade. They view themselves as the Bloomberg of trade, which is actually pretty impressive for a Canadian company. It's a great long-term success story, really well managed. But we always, when we first made the position, we were like, do they really kick out free cash flow? And the analyst made the argument, if they just stopped doing acquisitions, they'd kick off a lot of free cash flow. So we said, well, why don't they just stop doing acquisitions? They haven't. They do tiny tuck-ins in that whole time. But, we've gone from $6 to we're at
160 or
160.
Yes.
So it's been a very good one. And to be honest, it's a low maintenance stock. This is what we love about the name. When we initially went in the position, the CEO was a guy named Art Mesher, I think. And he had a great line where he said, at the start of every quarter, I know what 90% of my sales are because they have 90% recurring revenue. I spend the next 90 days worrying about the next 10% of our sales. So we met with Descartes in December and asked him, hey, does Art's thing still work? And he said, well, it's about 86% right now, but we're reasonably close. So you get that high recurring revenues. And on top of that, when there's more uncertain times in trades with tariffs, that really benefits them because they make it easier. They simplify the paperwork for people who are involved with this. So at the time where people are concerned that maybe there's less trade, there's actually more need for someone like a Descartes in this business. So we love it. It's a low maintenance stock. We just got to the point where a lot of the Canadian mid-cap stocks where we were like, why bother with these tech names? Why don't we just put all our money in Descartes?
So you guys invested back in 2011. Is now, as we said, up to 160. Would you still invest? Is there more growing to do?
Well, it's still very attractive. I mean, we grappled 13 years ago with the valuation. We still grapple with the valuation on it. It's not a cheap stock, but it's a great growing stock. We love the consistency of it. It's very predictable earnings. People love that. It's probably at 44 times or something earnings, but big tech stocks trade at ridiculous valuations, and it's one of those. So you're not buying it as a value play, but it's still a great growth story, and it's a Canadian success story.
Got it. All right, we will be back with more questions from you for Jerome Hass, portfolio manager at Lightwater Partners, and he's sticking around to take your questions, and then later in the show, top picks. We're back in a moment. Welcome back to Market Call, and thanks for joining us today. We are going right to your phone calls. Michael's on the line calling from Toronto. Hi, Michael. What is your question today?
Good afternoon. I'm a dividend investor. It's how I butter my bread. Not able to work anymore. I'm interested in freehold royalties. Is the north of 8% dividend rate safe? Because I need that. Thank you very much. I'll hang up and listen to your answer.
A short answer, Michael, is yes. There's been a lot of fiscal discipline in the oil patch and in Freehold. We met with them in January as well. Like the name, it's basically for dividend investors. I think it's a very safe way to play. You're not having as exposure to individual names. It's partly I wouldn't have all of your oil and gas exposure in it, but it's certainly part of that. So. Yeah, 8% yield. We think it's undervalued, certainly relative to Prairie Sky, which is another one of its peers out there. It seems to be attractively valued. I think it's worse places to park your money.
All right, 12.79 trading at this point today. Let's go back to the phone lines. We have on the line Tony, who's calling from Calgary today. Tony, what's your question?
Yeah, thanks for taking my call. Yeah, Jerome, the company's Capital Power, a very nice mix of, the natural gas, wind, solar spread out across the U.S. and Canada. What's he think about that pullback and where it's going next? Bye.
Yeah, so we're a past shareholder of Capital Power and also TransAlta, which is somewhat related to it as well. They're both power providers primarily in Alberta. And we were a bit taken aback by how strong both stocks were up until January 28th. And Capital Power was up about 65% in that period, and TransAlta was up 95%. And the reason for that is on January 27th is when the deep sea rumors came out. And so if you look in the chart there, it took a blip from then. And really the reason why they've been moving in the year prior to that is about the investor enthusiasm for artificial intelligence data centers in Alberta. So we were like, it's pretty sleepy names like the power segment that Capital Power and TransAlta deal with. They'll grow like 2.5% growth is great growth for the business. And all of a sudden to move almost 100% in TransAlta's case and 2/3 by Capital Power, we thought the market's getting pretty ahead of themselves. And I understand why people are excited about this. It's great for the nat gas industry. I guess these people are logical buyers of it, but that being said, in Canada, we're very slow to build anything. And I know, I think there's 2 applications that Capital Power has put in for data centers, but whether or not they get built and come into fruition remains to be seen. But I just think people got a little ahead of themselves. And you look at the valuation of Capital Power, I think it's around 8.5 times EV to EBITDA. Historically, they're closer to 7, so we're trading well above the 10-year averages. So there's a lot of hype built in IA in the 2 stocks, and I would just tread carefully on them on that basis. So I wouldn't be putting new money into Capital Power at these levels.
So you think it might drop a little bit more?
I think it's the AI hype
it's
will
diffusing
diminish.
a bit, yeah. Okay. Thanks for that question. We're going to move on to Mark, who's calling us today from Ottawa. Mark, what's your question for Jerome?
Hi. Thanks for taking my call. I like investing in banks. Slow, stable growth, not very growthy, like you said, but still, it's a nice place to park money. I'm just concerned recently with the U.S. government and Canadian government declaring Mexican cartels as terrorist organizations. I'm wondering which banks would be most exposed to that and what to go for, what to avoid. I don't know. Thank you.
Interesting question.
Interesting one. Yeah, I would say off the top of my head, Scotia historically has had the most exposure to Latin America. And I can't say specifically because I know they were reviewing that aspect of it in Mexico, but I think it's a relatively minor aspect of the banks. I mean, to me, it's more the overall economy and what's going to happen to the Canadian economy that I'd be more concerned about. And, I think Scotia's kind of been in the doghouse. CIBC was with them 2 years ago. CIBC seems to have become favored of the last 12 months. Scotia's still in the doghouse. TD was in the doghouse up until about 2 months ago, and they've had a nice run from, I think they got a little about 75. TD's now at 85. I don't know. I think I'd prefer to own the dogs, so either TD or Scotia.
Okay. Royal Bank's still a darling, of course.
But that being said, I'm probably the worst person to ask about banks because we've never owned a bank in 17 years. So.
Yeah. Mid-cap. Okay. Got that. Let's get our next caller. And Peter is calling from Niagara Falls, Ontario. Peter, what's your question today?
Yeah, hi. The question is, I'm thinking of buying a financial stock, and I'm thinking of Sun Life, or is there one that you prefer? Manulife or one that you prefer?
Well, I guess the question would be why own one of those two? They've had a great run of late. I mean, if you look back 2 months ago or 2 years ago, everybody hated Manulife and loved Sun Life. And I think of the latest earnings, that seems to have reversed itself pretty dramatically. There's just a point where, to us, and again, it's not a sector that we pay a lot of attention to, but just the fact that it was so downtrodden, Manulife, whereas the golden boy was Sun Life Financial. And as you can see in the chart, there hasn't really done that much in the last little bit. I think you could probably do better in a name like Fairfax Financial, to be honest. If you want a big liquid non-bank financial in Canada, to us it trades at 1.2 times book. It's probably should be about 1.7 times, so there's potentially close to 50% upside in that. Whereas when I look at Sun Life and Manulife, if there is a further fall in interest rates, that's not necessarily a good thing for them. So I wouldn't rush to put any money in Sun Life.
All right, consider Fairfax as the alternative.
Yeah.
Okay, we are out of time for calls today, but stick around because our guests will share their top picks. That's coming up next. Stay tuned for that. Welcome back to Market Call. It's time now for top picks. We have Jerome Hass with us, and he's going to give us an idea of things he's looking to invest in. Main Street Equity is his first one. Jerome, why Main Street Equity? What do they do?
So they're an acquirer, manager, and owner of midstream apartments in Western Canada. Okay. And so they're a play on population growth and the scarcity of affordable housing in Canada. And what was interesting about Main Street is that they have their own in-house teams that essentially they go out and they acquire these properties which are run down or underperforming, to use their euphemism. They fix them up, put them out in the market and get higher rents for them. So they can essentially acquire at, say, $125,000 for an apartment. Conversely, if you went out and built that, it would cost you $400,000. So it's very efficient in terms of their use of capital. It's kind of a great time to be in their business because, rents are rising. As in Western Canada, there's not rent control. So latest quarter, the rents were up 12%, vacancies are down. So it's a pretty good combination to have. What we also like about the company is they're very efficient in their use of capital. So they IPO'd, I think, 25 years ago. They haven't raised any equity since then, which is an absolute rarity in Canada, yet they've still been able to grow their business by 18% CAGR or average over that period. So we just think it's a phenomenal story that's not really getting a lot of recognition from the market.
Okay, let's move on then to a DRI Healthcare Trust. And this one we were talking a bit about at the break. Can you explain the process and why you're interested in it?
Yeah, so what they've done is they've kind of taken a page from the mining sector and applied the royalty model to pharmaceutical drugs. So say you're a pharmaceutical or a biotech company, you spent a lot of time in research. You've got commercialized drug, you start to sell it, but you probably need some money for marketing or other purposes or to keep the lights on. And so they'll sell a stake at the top line of that. So say they buy 3% of the revenues from this over the next 10 years, which is the average life in the portfolio. So they'll give the company, say, 50 to 150 million upfront fee. In exchange for that, they get their royalty on the top line. So it is an interesting business. It's a very asset-light business. Their EBITDA margins are 85%. It's a relatively new concept to the stock market. People are very familiar with it applying to the resource space, but they're not used to it in terms of pharmaceuticals. So they were, I think, the second listed one in the world. There's now 3 peers out there. And so we just think it's cheap. It trades at about 4 times EV to EBITDA. It's got a 4% dividend yield. And when you compare it to its peers, it only trades at 1.3 times book. Its 3 listed peers trade about 3.7 times. So literally you could double the share price and it would still be undervalued relative to its peers. Okay. And you compare it to like a Franco-Nevada, it trades at 4.8 times price to book. So
Got it. I do want to get to your last one here, secure waste infrastructure, because we're running out of time. So tell me about that one.
Yeah, so it's a waste management company in Western Canada. It's got very high recurring revenues. About 80% of its revenues are recurring. Very stable business. Used to have the title Secure Energy Services, and so it was valued as an energy services company. We think that's a mistake. It should be valued as a waste company. It trades at about 8 times EV to EBITDA. Its peers trade at 17 times, so literally it could be a double from here and still be in line with its peers. So good place to put some money. It's a stable company, and we like it.
Okay. So 3 good picks for you today. Thank you very much for coming in. We're going to take a quick look at the markets as we head out. So let's take a look at the TSX as we are moving towards our break right now. TSX coming up in 5, 4. There we go. 25,282. Actually down 231, almost 232 points right now. The S&P is down as well by 67. And the NASDAQ is also down at 279. So not a great day on the market so far mid-Friday. We'll keep a watch on that. Thanks for joining us here on Market Call today. We'll see you back here on Monday.